Has your life ever changed due to a recession? Or have you ever witnessed how people's life change due to a recession? In both cases, the outcomes are worse than we can imagine. And do you know what recession really is and how it affects us? Let's see how the 2023 global recession will affect the entire world. So, what is a recession? In simple words, a recession means that the economy is at its lowest. No money for people to accomplish their routine needs, an increased unemployment rate, and it goes on. But diving deep into the topic, a recession takes place when there is a period of lower output and a significant increase in the unemployment rate due to the negative impact of the output growth of a business cycle. The output of an economy eventually increases. However, growth in economic output may shift in results, forming a business cycle in which there are ups and downs in the economic activity. In the ditch of a business cycle, output growth can be negative or weak. This eventually leads to job losses and an increasing rate of unemployment. A recession can also be determined even before the quarterly GDP reports are out, based on some fundamental economic indicators like manufacturing data, the decline in incomes, etc. Although an economy can show hints of incapacitating even months before a recession begins, establishing whether the country is in a true recession often takes time. A recession is only for a short period, but its impact will be long-lasting. The business cycle refers to shifts in growth in economic output, taking into account the sturdy growth in the possible output of the economy. Output is the real gross domestic product, and potential output is the output level that the economy can attain when using all its resources, people, equipment, natural resources, and technology sustainably without putting outrageous upward pressure on prices in the economy. A business cycle has four main phases: expansion, peak, contraction, and through. In an expansion, households desire more goods and services. Businesses employ more workers, and salaries and prices usually increase. This stage ends with a peak in economic need. In the contraction phase, households solicit fewer goods and services. Businesses lessen the number of workers they hire, and growth in paychecks and prices slow. This phase ends with a through in economic shifting. Understanding the origin of recessions has been one of the undergoing areas of research in economics. There is a wide range of reasons that causes recessions. Some of these causes are associated with sharp price changes, which led to a sudden decline in expenditure by both the private and public sectors. Some recessions, like the 2008 global financial downfall, are rooted in financial market problems. Sharp price increases and rapid credit expansion often harmonize with debt aggregation. As businesses and households get broadened and face issues in meeting their debt responsibilities, they reduce investment and consumption, decreasing economic activity. All such credit booms do not end up in recessions. However, if that's the cause, these recessions become more costly than others. In some countries with well-built export sectors, recessions can result from a decline in external demand. The regional trading partners rapidly feel the adverse effects of recessions in large countries such as Germany, Japan, and the United States, especially during globally coincided recessions. Some recessions may also occur due to global shocks like the coronavirus-triggered lockdowns, which shut down economic activity in many countries. One of the outcomes of recession is unemployment, which tends to increase primarily among low-skilled workers due to corporations and even government agencies firing staff to trim expenses. Another consequence of the recession is a decline in output and business closures. A downfall in output tends to last until more vulnerable companies are propelled out of the market. Then, output elevates again among the surviving establishments. With more people out of jobs and households increasingly unable to survive, there will be a need for increased government-funded social projects. With a plunge in government incomes during a recession, it becomes challenging to meet the high needs of a social sector. The most famous or advised policy for any country to drill itself out of a recession is an amplified fiscal policy or fiscal push. This can usually be a two-spike scheme of tax contributions and increased government spending. There were 122 concluded recessions in 21 developed economies from 1960 to 2007. Although this displays a lot, recessions do not happen often. Undoubtedly, the proportion of time consumed in recession, gauged by the percentage of quarters a country was in recession over the full illustration period, was commonly about only 10%. Even though each recession has unique attributes, recessions often show several shared characteristics. One query occasionally asked is how a recession corresponds with depression, particularly the Great Depression of the 1930s. There is no standard definition of depression, but most reviewers consider depression to be an enormously extreme recession in which the decline in GDP transcends 10%. There have been only a few depression outbreaks in developed economies since 1960. The most current was in the early 1990s in Finland, which reported a decline in GDP of about 14%. That depression overlapped with the separation of the Soviet Union, an extensive trading associate of Finland. Through the Great Depression, the US economy shrank by about 30% over 4 years. Although the latest recession is clearly severe, its output cost was much less than that of the Great Depression. The wreckage of the Depression was so great that the outcomes of the Great Depression prevailed for decades after it ended. The stock market didn't recuperate until 1954. There are many views about what forced the Great Depression. Some shared beliefs possess that speculation and buying on margin were the reason for the stock market to collide in 1929. The smooth Hawley tax and the consequent freeze in international trade, the Fed inflating interest rates, and the gold standard, which led anxious investors to exchange their dollars in for gold. Your life would change dangerously if the United States encountered an economic dip on the scale of the Great Depression. 1 out of 4 people would lose their jobs. The stock market would fall by 50% and take decades to recover. The COVID-19 pandemic provoked a recession, but not a depression. Unlike the earlier years of the Great Depression, Congress operated extended fiscal policy to aid Americans. The CARES Act sent a $1,200 USD incentive check to qualified adults earning up to $75,000 USD. It also boosted unemployment benefits. As central banks across the world simultaneously increase interest rates in reaction to inflation, the world may be rimming toward a global recession in 2023 and a queue of financial crisis in emerging markets and growing economies that would do them enduring harm, according to a panoramic new study by the World Bank. Central banks worldwide have been increasing interest rates this year with a span of concurrence not seen over the past 5 decades, a tendency that is likely to persist well into next year, according to the statement. Yet the currently anticipated course of interest rate increases and other policy actions may not be adequate to bring global inflation back to the levels witnessed before the pandemic. Investors anticipate central banks to raise global monetary policy rates to almost 4% through 2023. In addition to more than 2% points above their 2021 average. Unless supply disorders and labor market pressures decline, the study finds that those interest rate accumulations could leave the global core inflation rate at about 5% in 2023, almost double the 5-year average before the pandemic. To trim the global inflation to a rate compatible with their targets, central banks may need to increase interest rates by an additional 2 percentage points, according to the statement's instance. If this were escorted by financial market tension, global GDP growth would restrict to 0.5% in 2023, a 0.4% compaction in per capita terms that would meet the technical meaning of a global recession. The study underscores the unusually fraught events under which central banks are battling inflation today. Several chronological indicators of global recessions are already flashing alarms. The global economy is in its abruptest deceleration following a post-recession recovery since 1970. Global consumer faith has already suffered a much steeper decline than in the run-up to forenamed global recessions. The world's 3 largest economies, the United States, China, and the Euro area, have been delaying dashingly. Occasionally, even a mild hit to the global economy over the next year could pitch it into recession. The study depends on understandings from previous global recessions to examine the recent shift of economic activity and presents plans for 2022 to 24. A downshift like the one underway generally calls for a counter-cyclical policy to help the activity. However, the danger of inflation and limited fiscal space are urging the policymakers in many countries to withdraw policy support even as the global economy hinders steadily. The experience of the 1970s, the policy retaliation to the 1975 global recession, the following period of crisis, and the global recession of 1982 demonstrate the risk of letting inflation remain raised for long while the growth is fragile. The 1982 global recession overlapped with the second lowest growth rate in expanding economies over the past 5 decades, second only to 2020. It initiated more than 40 debt crises and was tracked by a decade of yielded growth in many evolving economies. So what do you think would happen? Will the effect of the upcoming recession be more than we ever witnessed? Or will the central bank statements go wrong? Comment down your views regarding the same. Until then, bye!